Thank you. Okay, multiplied by depth, so we will take the value we found before divided by equity. Okay, and then we will find a levered beta equals to, I think it's 1.02. Okay, so it's levered beta. Okay, and now we have just to apply the formula of the CAPM. Okay, so that means we have AE, RF is 5, plus the levered beta 1.02, multiplied by the market risk is 5.5, I think. Okay, and then we obtain, just a moment. $10.61. Oh, where is it? 10.61%. Okay. Then we have 10.61. We have this weight. LD, we know that it's 5.5. Okay. Tau is equals to 35. Okay. And then we obtain a WACC equals to 9.2%. Okay, so it's the WACC of Boeing. Okay? Is it okay for everyone?
Yes.
Okay. Do you have any question about that?
Not yet.
Okay.
Okay.
Okay, so now I would like you think about the optimal capital structure. So it's the WACC of Boeing in 2009, but the second question is about the optimal capital structure of Boeing. So I would like we check that this capital structure, this current capital structure, is an optimal capital structure. That means that the WACC is minimal. Okay, so you know that if we look at the debt over V and the WACC, in practice, we observe that the WACC is like this. So you can see that here we have the optimal ratio, okay, for which the WACC is minimal. So the question is to check, is to find what is the minimal WACC of Boeing, okay. So to do that, we will make change of, we will take a table with D over V. So we will assume 0%, 10%, 5%, 30%, and so on, okay? And we would like to find the WACC, okay? In order to look at which level of debt the WACC is minimal, okay? So I would like you to try to do that, okay? Knowing that each time you will make change of the debt, of the amount of the debt, of course, RE will change, okay? RD will change, and then the WACC will change, okay? So I would like you try to think about this kind of table, okay? You can try to do on Excel, okay? So you take different level of debt, okay? And you try to do that, okay? I would like you try to do that in order you will understand the question we have, the problems we have when we are doing such exercise, okay? So that's why I would like you try to do, okay? So So, do you understand which problems we have?
Can you repeat the question again?
Do you try to do? Yes. Do you understand which problems we have when we try to find the optimal capital structure? Do you what is the problems we have when we make change in the debt equity ratio? So our objective is to find the optimal capital structure in order to have the minimal WACC, okay? So the problem is that when we will make change in the variation, RE and RD will change, of course, because each time the ratio debt over equity increase, okay, RE will increase and RD will increase. But the problem is not for RE, because we know that each time debt over equity change, we will have change about beta of equity, okay? Beta of equity will increase, okay, because we know that beta of equity is equals to beta A multiplied by 1 plus 1 minus 2 debt over equity. Then RE will increase, okay? But the problem is not for these two components because it's relatively easy to measure the impact of an increase of the debt ratio. The problem is really for RD. Why? Why we have problems for RD? Because you know that each time the debt will increase, RD will increase. But the problem is how to measure the increase of RD. So you know that each time the debt increase, okay, the credit risk will increase, okay? The credit risk will increase, okay? If the credit risk increase, then RD will increase. But do you have an idea to measure the credit risk? How can we measure the credit risk premium? Do you remember what I told you last time to measure the credit risk? What do you think about the measure of the credit risk premium? What I told you last time. In order to measure the credit risk.
Hello anh em.
So you don't remember to measure the credit risk premium. You know that we are able to use the synthetic ratio, and I told you that the ICR, interest coverage ratio, is will help us to measure the rating of the company and then the credit risk. So ICR is the EBIT divided by interest expenses. And if you look at the information I give you, here you have appendix, and we have the EBIT, okay, that is equals to 1,000,751, okay. And if we have the EBIT, we are able to calculate the interest coverage ratio, and then we will have the rating. And if we have the rating, we will find RD, okay? So that means we will try to look we will try to okay, no, I will add another credit risk in order to calculate LD. Okay, I will take, so I will make variation in debt. I will have the value of the debt, the market value, debt market value. Then I will calculate the interest expenses. Okay. I can calculate the ICR because ICR is EBIT divided by interest expenses. And according to the ICR, I can say that the rating is AA, triple B, and so on. And then I will find LD. Okay? So can you try to do that? So you take a table, okay, with a different variation of debt over V, okay, in order to find LD, okay? So can you try to do that? I give you 5 minutes to do. So So what's the problem when we have to do that? What's the problems when we have to do that? No problem for you? So you see that I will show you. The problem is that to calculate the ICR, we need the interest expenses. And to have the interest expenses, we need to have RD, or we use the ICR to obtain RD. So we have a circular problem, okay, because the solution is to use the ICR to find RD, but to calculate the ICR, we need RD. So we have a circular problem. So I will show you how we can resolve these problems, okay? So here you have, so the calculation of WACC, and here I made change of the leverage ratio, okay? So it's a D over V, okay? And then I have another column with debt over E, okay? And here we have the leverage beta, so it's not complicated because we have the new ratio. So we can estimate cost of equity. So you can see that when the leverage ratio increase, the leverage beta increase, okay? Beta of equity, and then the cost of equity increase because of the increase of the risk for shareholders. So it's normal, it's not complicated, and we don't have any problems to calculate the cost of equity when we make change in the leverage ratio. The problem is for RD, because for RD, here cost of debt, We can use we should use a synthetic ratio to estimate the rating of the company. But the problem is that if we use, for instance, the ICR, we need to have interest expenses, and to have interest expenses, we need to have the cost of debt. So we have a circular problem. So to solve these problems, we can assume at first that we have the rating AAA. So it's the best rating, okay? So here I create a new column with the debt amount. If we assume a leverage ratio of 10%, we will take the market value of the company that is equals to $40 million. So we will take 10% of the debt, okay? And okay, then we will assume that we have the best rating, so AAA. If we are AAA, that means that the cost of the debt is 5.2, okay? So here we have the debt amount. To have interest expenses, we will take the debt amount multiplied by the cost of debt. Then we have interest expenses amount equals to 212 million. Okay. We have the EBIT, and then we can calculate the interest coverage ratio, that is equals to the EBIT divided by interest expenses. Then we have an interest coverage ratio of 8.25. If we look with the appendix 8.25, we are not able to have the rating AAA, but we have the rating AA. You will understand? Okay? We have the rating AA and not AAA. So I come back and I will put AA. But if I am AA, that means we have AA. That means we have AA 5.5. So I come back and I will put 5.5. Okay. So 5.5. Of course, if I am 5.5, the interest expenses will increase. So now we have 224. And then the interest coverage ratio decrease, so it's equal to 7.8. And I have just to check if I have an interest coverage ratio equals to 7.8, is it okay to have a rating of AA? So I come back on my table here, 7.8 here. Okay, so I am able, I am allowed to have the rating AA. Okay, and now I can go on. Okay, here. Okay, so I can stay AA, and for that I will stay AA. AA, that means I have the cost of debt of 5.5. But that means I have an interest coverage ratio of 3.43. 3 point, okay, so I have to be A- and not AA. Okay, so I will put A-, and if I am A-, I have the rate RD equals to 6.25. So I am A-, 6.25. And so multiplied by, okay, interest coverage ratio is equals to EBIT divided by interest expenses, so 3.43. Okay, so I can state A minus. Okay, I can state A minus. Okay, because to have the rating A minus, the ICR should be between 3 and 4 point. Oh, no. Yes. So I am able to be A minus. And I go on like this, okay, for the other level of the debt, okay? Then I obtain RD, the cost of the debt, okay, with the rating, okay? And I have just to calculate the marginal tax rate. Because you know that marginal tax rate for borrowing was 35%. But you know that the tax saving due to the interest rate are not illimited, okay? Because it will depend on the operational income, okay? And we have to calculate the maximal tax saving. So the maximal tax saving is just the EBIT multiplied by tax rate. So it's 1,751,000,000 multiplied by 35%. So it concerns the maximal tax saving. That means that, how to say, when the interest expenses are higher than the EBIT, okay, the marginal tax rate will decrease, okay? So EBIT is 1,751,000,000. So when we have a debt over V equals to 50%, the interest expenses are higher than the EBIT. That means the marginal tax rate will decrease and will be equals to maximal tax saving, okay, divided by the interest expenses, okay? So marginal tax saving divided by interest expenses. Okay, so you can see that when the debt increased too much, okay, with very high level of interest expenses, the marginal tax rate that will generate tax benefits due to the interest rate decrease. And then we have the after-tax cost of debt. So after-tax cost of debt is equals to after-tax cost of debt is equals to LD multiplied by 1 minus T, okay? And T is the marginal tax rate, okay? So it's the after-tax cost of debt. So I have the after-tax cost of debt, so I can add in my table, and then I have the WACC. And you can see that the minimal WACC is 9.18%, okay, for a debt leverage of 30%, okay? So we find the optimal capital structure, okay, looking at the minimal WACC, okay? And you can see that at first, without debt, WACC of borrowing is 9.82. Then we decrease the WACC when we increase the debt at first with a minimal threshold, okay? But after this threshold, okay, here, we can observe that the WACC increase because of the increase of the risk about cost of equity and after-tax cost of debt, okay? And we observe that we can observe that we have, how to say, so I would like to, okay, and okay. So here we have no, it's not very clear, but we can observe that it's like U curve, okay, with at first a decrease and after an increase of the WACC. Okay? Is it okay for everybody? Yes or not? Is it clear for you? Is it clear for you?
Yes, could you please share us this
Yes, I will
file
send
later?
Okay.
Yes, thank you.
Okay, I send you the file.
Excuse me, Miss. In my previous email I have sent you, I already asked about the mock test.
Yes, I look, but I don't have with me, but just a moment, because I have, so I'm just sending you the Boeing case, the correction.
Yeah.
Just a moment, okay, because about, I will, because I don't have my last computer, just a moment.
Okay.
Okay. Okay. So for the question of the exam, so I think the exam will be held on the 21 of April. Okay. So you will have an exercise about the capital budgeting as we did together. Okay. About the estimation.
Same as this one?
Okay. As we did together, okay, the same kind of exercise with the estimation of the cash flows, the calculation of NPV, okay. You are sure that you will have an exercise about that, okay. And you will have also an exercise about the valuation of WACC, but more simple than the case of Boeing, okay? It will be more simple case, okay? Okay, and you will have maybe some question about the course, what we did together, about the main explaining factors of capital structure, but no bad surprise for you, okay? It will be as in line with what we did together, okay? So I think 2 exercise and
one question.
Yes.
Okay.
Okay.
Yes, perfect. Thank you.
Okay. Do you have another question?
Sorry.
Do you have another question?
Another question?
Do you have?
So you just sent us the answer or the key for Boeing case. So how about the question, the background, the case background in question?
She sent in the chat box.
Yes, but I can send you back again.
Ah, okay.
I send you
Because-
yes in the chat box.
Yes, but I have just seen the key, the answer, the Excel file, right?
So you have
How-
okay. You need Boeing case of the
Yes,
correction.
I want to check
Ah,
the background
okay.
and the question for this case.
Okay.
The
Of
Word
course.
file, I mean.
But I think, but at the beginning of the course, maybe you wasn't here. Okay. 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 Okay, so I will share you another file, but just a moment. Okay, where is it? 2000.
Could you kindly send us the noted version of Boeing case?
I don't. What your question?
The Boeing case, the what version with your note today?
I don't know how to send you.
Okay.
I will try just okay. I will try to okay. Just a moment. Okay.
Yes. You can save it as a Word form doc.
Just.
Yeah.
I'm looking if I record. No. Okay, so I will try to do something. Whiteboard. Okay. So I have the first one. So you can look. Okay. I am trying to.
Do you use whiteboard application?
Yes. Do you see the whiteboard in the chat box? Yes.
Yes.
Okay. So I send you. Okay. Okay, but I think it's okay. Yeah. Okay, so now.
Okay, we got it.
Yes. Is it okay for you?
Yes, it's okay.
Okay. So I will send you part 3, but it's not the program of the exam, okay? It's just for you because, okay, it's about the type of financing, okay? So you can look at this document, but maybe so you know it's different very important point you have to know about the different types of financing. So You have the features, for instance, if you take the chapter 2, debt financing, but I think you know, so debt financing is features, is the main, we have a main different features about the maturity, the guarantees, the priorities, okay? And just, I will show you, okay? Here you have the debt hierarchy, okay? You have the different features of the different forms of the debt, and I recall the different points we find in a loan documentation, but I think you're okay with that because it's very not complicated. I give you some information about a syndicated loan, about bond market, but I think you know, okay, this kind of financing. And just at the end, you have hybrid financing. So hybrid financing, I just would like to give you some information about hybrid financing, because hybrid financing concerns all kinds of financing that mix the features of the debt and the features of equity, okay? So, of course, the main features of hybrid financing is that it contains options, okay? It contains options because we have different features in the contract that give the right for the issuer or for the investors some options, okay? So it may be call option, put option, and so on. And this kind of financing generates a very high level of flexibility for company. That's why maybe it may be very useful for company using to use this kind of financing, because that brings flexibility.
It's important
and especially when the uncertainty is very high, and it's due to this flexibility is generated by embedded options included in such financing. So the more popular hybrid financing instruments we have, so we have bond cum warrant, we have convertible bonds, equity exchangeable bonds. We have different kind of hybrid financing, and after I give you some information about each kind instrument, hybrid financing instrument. So, for instance, a bond cum warrant is a bond plus a warrant. And you know that a warrant is a call option that, in fact, it's a security that allows the holders to subscribe to another newly issued securities during a given period at a price that is fixed in advance. So the particularity of the bond cum warrant is that each component traded and negotiated separately after the issue. But in fact, we value the warrant using a call option. We say that a bond cum warrant, in fact, it's a bond, so a debt, plus a call option, and the call option is an equity component, of course, because the underlying is the stock price of the company. Okay, so okay, for that, so you have also information about convertible bonds. So a convertible bond, it's a bond, but it's an hybrid financing tools because the investors own the right to convert these bonds to a given number of stock at the end of the contract. So in fact, it's a bond value, it's a bond plus a warrant. So it's like a bond cum warrant. In fact, in terms of valuation, it's the same. So in terms of valuation for standard convertible bonds, so we say that a convertible bond is a bond plus a call option, okay? And in terms of exercise, so just a moment. In terms of valuation, so we say that convertible bond is a bond plus call option, and in fact the underlying is alpha S, so it's the number of stock, it's a number of stock that is indicated in the contract. So it's the underlying. So we call this in the underlying, we say that it's a conversion value. It's what the investor obtains if he decides to convert. And for the exercise price of the call option, it's the cash redemption, it's the redemption price of the bond, okay? So it's the exercise price of the convertible bonds. And we have also the maturity and so on, okay? So each time the conversion value exceeds the redemption price, okay, so the investors has a right to convert its bond in equity, okay? So that means at the end, if we take a convertible bond, so during the life, you will receive coupon, okay? And if it's an European option, for instance, T4, the investors will have the choice between the redemption price or the conversion in stock, okay? So it will take its decision comparing the redemption price and the conversion value. So if the conversion value is higher than the redemption price, you will decide to convert, okay? So in this case, that means the company doesn't have to pay for the cash, the redemption price, but we will have a new equity issue, okay? And at the opposite, if the investor decide to ask for the redemption price, okay, the company will have to pay for the redemption price, and we won't have a new equity issue, okay? Do you understand? Yes? Okay, so this kind of financing is very interesting because we consider that the investors hold a downside protection, whereas it can also benefit from an increase of the stock price in case of success of the company. But if the stock price doesn't increase, so is like a bondholders, and then he has a downside protections. You understand? So that tends to introduce a speculative dimension in the financing of the company, because when the uncertainty is very important, it may be very interesting for investors to how to say, to cover from this kind of risk, especially in case of a very high level of informational asymmetry or high level of agency cost, for instance. It may be a very useful financing because it will decrease the uncertainty for the investor, because the investor hold more flexibility according to what happened in the futures, okay? Because, you know, for instance, if you take an innovating startup, the features of this kind of company is that we have a very high level of uncertainty in terms of investment. And of course, the motivations for company to use flexible financing is very important to be in line with the uncertainty of the investment, you know. So we know that we have very high level of uncertainty about the investment. So we need to have flexibility in terms of financing. You understand? Okay. Okay. So do you have any question about these points?
For me, it's no.
No? Is it okay for everybody, for everyone?
Yes, it is.
Okay, okay. So I propose we stop now, okay? I think it's okay. And if you have any question before the exam, don't hesitate, okay, to send me an email, okay? But I think it will be okay. Do you know the duration of the exam? It's 1.5.
We don't know yet.
Okay.
Yes. So can you please inform us? It's
Okay.
1 hour and a half or 2 hours?
Yes, okay. I don't remember exactly, and I don't receive any information about offer from Anne Bui. So, okay, but I think she will tell me. Okay.
Yes.
Okay.
Okay.
Okay. So, thank you very much. Okay. Bon courage, because I know you have Franck Moreau tomorrow. Yes. You have a new session.
Yes.
Okay, okay. So thank you very much, and see you soon, okay?
Yes. Thank you very much.
Okay, thank you.
See you later.
See you later. See you. Bon
Yes.
courage à vous. Okay. And don't hesitate if you have any question.
Yes.
Okay.
Thank you.
Thank you
very much.
Bye-bye.
Thank you. Bye.
Good night. Good night. Thank you.
Good night, madam.
Good night.